Hello, my name is Suresh Supriti. My student ID is EMB24358, and I am a student of Master of Professional Accounting and Master of Business Administration. And today I am going to this presentation about my subject Corporate Accounting and its assignment presentation. I have some different questions topic about in this subject, and which is summarized by as executive summary, which is usually substantial variations between the accounting profit pre-tax of business and the taxable profit revenue. Since commonly recognized accounting rules and used to calculate financial pre-tax revenue is used to determine taxable income for the purpose of paying income taxes. My paper is aims to the proposed alternative strategy for paying income taxes and the impact of income taxes where assessable benefit and private income diverge. Accounting profit. Accounting profit, also referred to be as a bookkeeping benefit, it is the net profit that exceeds in compliances with the specific expenses from the gross sales of a company. Such expenses include labor prices, cost of raw material, transportation cost, and the cost of production. Another one is taxable profit. Taxable profit is the percentage of profit used to be measure the amount of tax payable to the government by a person or a corporation in a tax year. This is usually known as modified taxable profit, which is entire salary referred to as regular income minus any eligible deductions or exemptions during the tax year. Temporary difference. Temporary difference are discrepancies between financial accounting and tax accounting laws, which is cause the taxable pre-tax accounting income to be higher or lower than the taxable income in the current period and lower or higher in future periods by an equivalent amount. Deferred tax assets. Deferred tax applies to either a favorable assets or negative liability entry in a company's balance sheet in consideration of a tax owing or overpaid due to the temporary discrepancies. Deferred tax will fall into the group of two and is withheld tax obligations and tax revenue withheld. Deductible temporary differences. The immediate variances are the discrepancies between assets and debt bearing number and its tax base. The tax base is the amount of taxable benefit or debt, and a liability tax base is normally its holding balance minus some that would in fact be tax deductible. I'm talking about some recognition criteria of the deferred tax assets. The deferred tax benefit shall be remembered for the continuity of accurate tax liabilities to the sum of the current tax benefit, taxable minor variations of an acceptable kind, collecting them in an reasonable period. The removal of such immediate taxable discrepancies allows for the utilization or accurate tax reductions and support the identification of deferred tax savings. Another one is deferred tax liability. A deferred tax duty or deduction is created where there are slight differences between book tax and actual income tax. There are various types of transactions that may produce small revenue gaps between the pre-tax ledger and taxable profit, resulting in deferred tax assets or obligations. Number two is forms tax expenses from the latest financial statement. A tax cost is a debt due over a specified duration to federal, state, province, and or local governments. Usually over the span of a year, tax expenditure are determined by multiplying a person or business effective tax rate by income received or produced before taxation. After factoring in factors such as non-deductible products, tax assets, and tax liability. Number three, difference between the tax company and the tax rate with the firm's accounting income. Corporate tax is a compulsory tax levied on the profits or property of companies or related legal bodies by a state. Most nations levy these taxes on a national basis, and a related tax can be levied on the state or municipal level. The tax can be called either income tax or interest tax. Number four is deferred tax assets and liabilities of the firm, things on a company balance sheet which can be utilized in the future to mitigate taxable profit are considered deferred tax assets. When a company has overpaid taxes on the balance sheet or charged taxes in advance, the situation would emerge. These profits are then allocated to the business in the form of tax reliefs, although consumer overpaid is considered to be a benefit. Number five is tax assets or income tax payable recorded in the company. Reason why income tax payable not same as the income tax expenses. Tax charge is what we estimate our company owes in taxes that are based in the sector's normal accounting principle. Our report the changes on the financial statements. Sales tax due is the total tax payment owing by the corporation. Depending on the laws of the tax code, profit tax payment tax as a balance sheet debt before the company pays the tax bill. Over the span over time, there will also be variation between financial and tax accounting. Number six is income tax expenses in the income statement. An integral part of the corporation balance sheet is the cash flow statement and income statement. The cash balance statement or cash position statement calculations the flows of revenue by a business and the capital needs for a given time span. So the income statement measures the financial performance of a company, such as revenue, expenses, profit or loss over given a period of time. Number seven is temporary difference and permanent difference. These are the occasional inconsistencies when a company gain or deficits are reported in the financial report in different years that in the tax returns. These differences can involve inconsistencies in revenue figures, incurred but not yet paid expenses, or depreciation calculations. Number eight is treatment of tax in the income in the company's financial statement. A corporation income tax strategy must comply with the strategy program, so that is to maximize income, and a company has to understand whether it incurs tax liabilities or and adjust its policies accordingly. As a summary, my study has proved to be very useful in understanding that tax is a challenging field to navigate, where even the most experienced financial analysis often get lost. It bears in mind that there are multiple tax codes and regulation in any one jurisdiction, but several jurisdictions with various tax laws to intensity the impact. That's all done. Thank you very much.